An option is a contract between a buyer and a seller that specifies four things: rights and obligations, the underlying security or commodity, the expiration date, and the strike price. And there's two types of options: call options and put options. With a call option, the buyer gets the right but not an obligation to buy an underlying security, like Apple stock, from the option seller within a specific time period and at a set price, known as the strike price. With a put option, the buyer gets the right but not an obligation to sell underlying security, like Apple stock, to the option seller within a specific time period and at a set price, known as the strike price. For example, you might buy an Apple call option with a $150 strike price that expires on December 1st. In this case, if Apple trades at $150 or more on December 1st, you'll have the right but not the obligation to buy 100 shares of Apple for the strike price of $150. Investors trade options for all sorts of reasons. It could be to generate income, hedge against potential losses, magnify potential profits, and speculate. But for the purposes of this course, I'll be covering all four topics through high probability trades with equity options. Commodity, index, forex options are topics for another course. Equity options are options whose underlying security is an equity or a stock like Apple or Google, or an index ETF such as the SPY, which is the most popular ETF to gain access to the S&P 500 companies. The next video will cover the basics of buying call options.